Coming into today, everything was going to be about what the Fed had to say, and the Fed ended up being very dovish. Yesterday, we outlined 3 possible cases of what the Fed could say. They gave us the best case scenario, and that's we're going to keep doing what we're doing. We're going to keep interest rates low. We aren't seeing, a total recovery in the economy yet. We haven't seen the unemployment rate fall significantly to pre-pandemic levels and be at full unemployment. So until that happens, we're not going to do anything. That's good for the market. That means continued liquidity, not hardcore rising interest rates. And I don't even think a little bit of a rise in the interest rate matters at all, especially because there's inflation. The Fed also said they expect there to be some inflation. And some inflation is a good event for the market. So we have addressed the Fed. Now let's talk about the market and how the comments of the Fed will affect the market. If interest rates are low, that's a stimulative measure. There's going to continue to be increases to the money supply, and that will cause some inflation. And as there's inflation, prices will go up. Now, the concern with inflation is if I have a company and I have to buy things for my product, am I going to be hurt? Because now all of a sudden I'm paying more for my input costs. Well, there has been an area of the economy, one of many, that has already been experiencing inflation for some time, and that's the real estate and housing areas of the economy. Lumber is up significantly. Copper is up over 100% in the last year. Housing prices are up 14% year on year. So you have the input prices rising. You have the sales prices of the final good rising as well. Yet the housing market is experiencing a boom and close to record demand. So I believe this effect is going to take effect across the broader economy in every single, most, if not all, categories, because savings rates are at all-time highs. People have taken this pandemic, cut back on spending. Yes, it has hurt us in the past, but in the future, consumers will have money and ammunition to spend. And I believe that will be good for the market and the broader economy. So we will open up next stage, and people will, have possibly some pent-up demand, or will at least have pent-up savings and ammunition to spend and demand goods. Now, as they demand goods, we'll see the same kind of effect we saw in the housing market when we saw an increased demand for housing and an increased demand for input prices, for products rather, for housing. Housing prices ultimately went up. Companies will experience, yes, an increase in final sales costs or in input costs, but will also experience an increase in final sales costs. I believe that they will experience increased margins. So the difference will, at least in nominal terms, increase. They'll, find a way to net out the increase in expenses with the increase in final sales products, and the economy will remain balanced in that way. And earnings will increase. PE multiples will fall, assuming no increase in the stock price. But ultimately, I believe the stock price will increase because these companies are now earning more money, at least in nominal terms. I don't know what the real effects of the inflation is going to be. Maybe we're at a lower level of productivity and the economy hasn't really increased, but we've essentially tacked on another zero, but it's not going to be like a zero. It's going to be like a times 0.105 situation. Anyways, it's good for stocks, especially continuing low interest rates, especially increased liquidity. So ultimately, I expect the market to break through, S&P 500 to break through 4,000 and continue for some time. I don't know when it's going to stop. We kind of have to see where it goes, but I'm not going to be surprised if it breaks 4,100, 4,200, and then 4,300 over the next couple months. So hold. That's my message for today. And until next time, peace out.